Okay, here's the profit. Okay, the profit is the result. Okay, there's no book account under the name profit. Why? Because by the end of the period, when I say the end of the period, could be one day, could be each single day. So if your company incur 20 sales, you don't have to calculate profit from each sales. By the end of the day, by the end of the week, by the end of the month, by the end of the year, this is called end of the period. Say for example, you only have one transaction, okay? For any reason, your company for the day only one transaction. So the profit is kind of easy to calculate because the income statement for today is one revenue. On the top, there's the structure of the income statement. You have a 12,000 on the top, and you have only one cost of goods sold, 8,000 in the middle, and the bottom line, you come on the result, 4,000. And this 4,000, by the way, if you want to close the book, this 4,000 go to equity, right? You can see you have 12,000, you have 8,000, so you have 4,000 surplus. So 4,000 go to the shareholder. So for each transaction, well, if you want to be bothered like that, no problem. Each transaction you calculate the profit, and the profit go to equity, then you have income statement totally closed, totally wipe out. So this is the 4,000. So 4,000 finally go to equity. But if opposite, you lose money, for some reason you just want to move this inventory out, and the inventory cost 15,000, and your sales only 12,000, you lose 3,000, the 3,000 come here, reduce the equity. Okay? So, yeah, you mentioned that because that may be the last step. You close out the income statement and transfer the number to the balance sheet and under equity. Alright? Any questions so far?
Equity is profit?
You can say that, right? Yeah. I still want to differentiate. Okay. Dr. Liu just mentioned. Can we say profit is equity? You can say yes, but I still prefer to differentiate. Why? Because the terminology profit, if we give this terminology a very specific meaning, profit should appear on the income statement. You got it? Revenue on the top, cost in the middle, and then probably expenses, right? And the bottom line is called profit. So even though $4,000 same amount, if this $4,000 appear on the income statement, we say this is a profit. However, when we close the book, income statement, we transfer this 4,000 to the balance sheet. We don't use profit anymore because profit, this terminology, does not appear on the balance sheet. When we transfer this 4,000 to balance sheet, we also change the name. We don't use profit anymore. We don't call this profit anymore. We call this is retained earning. Retained earning. Even though 4,000 is the same number, but I prefer we differentiate. If we say this is a profit, we still mean this number still stay on the income statement. However, when we close out the income statement book by the end of the period, we transfer this balance, we transfer this number to balance sheet, we change the name. We say this is retained earning. Got it? So I highly prefer, don't say profit on balance sheet. We say return earning on balance sheet. So any questions so far? So far so good, right? For chapter 7, okay, we're gonna talk about this. Because right now we just give you 8,000 amount here. But for chapter 7, we're gonna calculate what is the cost or what's the value of the inventory. And they are basic 2 or eventually 3, okay, methods to calculate the value of inventory. And we only talk about 2. It's called either called FIFO or LIFO. Okay, FIFO or LIFO. FIFO versus LIFO. We eventually we talk about this issue in the taxation course. Okay. And really depends on your company's accounting policy. You set it up. You set it up. However, when you set out this method, you cannot change that. You cannot change it. You need to stick with. Okay. If you want to change the method, you need to get the approval from IRS. Okay. Eventually, for the public company, okay, public company means your company's stock is trading, okay, on the stock market. There are 2 federal government agencies over supervise your company. Okay, for your accounting purposes, you need to report to SEC. Okay, Security Exchange Committee. Okay, that is the federal government agency supervise your accounting. The other is IRS. The other is IRS. Right. The funny thing, okay, the very funny thing, okay, is number 1, you are the company who set out the policy. You want to use FIFO or you want to use LIFO. Number 2, if you want to change that, you need to get the permission from SEC and also IRS. Number 3, very funny thing, okay? You can choose different method on different inventory. Very funny thing. Okay? Say you have a millions inventory, okay? I can imagine for any kind of manufacturer, okay, you have thousands, you have more than 1,000 inventory. You can choose FIFO on item 1, LIFO on item 2, and FIFO on item 3, whatever you want. Okay? And let's see what happens. Okay, let's see what happens. What is this FIFO? FIFO means first in, first out. First in, first out. This is FIFO. LIFO is opposite. Last in, first out. Think about this. Think about this. Alright. If your company is a public company, right? I mention this all the time, and it is legal in the United States. It's legal. You have at least 2 conflict. You have 2 conflict objective. Number 1, you want to make your stockholder very happy by the end of the period. You have the financial report. You want to make this group of people very happy. Why? You want to show them you have a very, very high profit. High profit means 2 factors, right? High sales, low cost, and low expenses. And you see the result. Right? So if you want to make your shareholder happy, you want to make high, assuming everything's real. Okay? No fraudulent, okay? Every number, every figures here they're all real. So for the stock market purposes, okay, you want to have a high revenue, you want to have a low cost of goods sold, then you have a very maximum profit. This is one objective, right? The other one is totally conflict. You want to reduce your tax liability, right? You want to have a lower revenue, you want a higher cost, they have a minimum profit and subject to income tax. And for every business people, this is a fundamental. Even you don't come to here to learn your MBA, you know it. You know it. And in the Asian country, everybody know. They have two books. One for the manager, for the owner. I know what's the real number there, right? And the other number is just to report to the IRS. That is in Asian country. In the United States here is also true, but here is legal. Allow it, permit it. So you can have one set accounting book report to SEC, one set of book report to the IRS. Totally okay. You just follow out and consistently, you will be fine. So let's talk about here why you want to choose FIFO for one set and LIFO for the other set. So that is the basic idea. Alright? So let's see what happens here.